Today, we're diving into a really fascinating, high-stakes situation for a company called SanDisk Corporation, ticker SNDK. This is a classic story of just explosive growth running headfirst into extreme risk, and it creates a perfect dilemma for a swing trader. So let's break it all down. But first, the really important stuff. Everything we're about to talk about is purely for educational and informational purposes. Think of it as a case study. It is absolutely not financial advice, and please remember, all investing and trading comes with significant risk. So why SNDK? Why are we even talking about this stock? Well, because in the last 12 months, the stock put up a gain of 1,100%. Yeah, you heard that right. That is the definition of a parabolic move. It's the kind of thing that gets every single trader to sit up and pay attention. But here is the catch. Right after that unbelievable run, the stock just took a nosedive, dropping 16% from its all-time high. And that brings us to the million-dollar question. Is this a golden opportunity to buy the dip on an absolute market leader, or is this a massive red flag that the party's coming to an end? To figure that out, we first have to understand what lit the fuse on this rocket ship. So let's start with the bull case, which is built on some seriously impressive, fundamental firepower. The story really starts with revenue. In its last quarter, SanDisk reported 61% growth compared to the same time last year. You know, in today's market, for a company of this size to accelerate like that, it's just almost unheard of. It shows you how intense the demand for their stuff really is.
But the revenue beat? That was just the warm-up act. The real story was on the bottom line, earnings. SanDisk didn't just beat Wall Street's expectations, they completely shattered them, coming in 78% higher than predicted. Wow.
And if you thought that was impressive, check out where they're telling everyone they're headed. This quote from their forecast, this is the heart of the entire bull argument. Management is guiding for next quarter's earnings to be more than double the record-smashing quarter they just had. I mean, that's the kind of forward-looking statement that just pours fuel on a rally.
And this growth isn't just about selling more stuff. It's about selling the right stuff. We can see a really smart, strategic shift happening inside the company. Their data center business, which is growing like crazy, is now almost half of their total revenue. This is the part of the business that's plugged directly into the AI boom, because training those giant AI models requires a ridiculous amount of high-speed memory, exactly what SanDisk sells. So you put it all together, and the picture is just crystal clear. SanDisk is firing on all cylinders. They've got a global memory shortage working in their favor. They are a key supplier to the AI gold rush. They're locking in customers with long-term deals. And on top of all that, they now have more cash in the bank than debt. That is a seriously powerful combination. Okay, but as with any stock that's gone this far, this fast, you know there's another side to the story. So let's flip the coin and look at the bear case, and you'll see how this incredible opportunity is balanced on a tower of risk. And this slide just lays out that conflict perfectly. On the one hand, you've got this explosive AI-fueled demand. On the other, you have a chart that's gone parabolic and looks fragile, especially in a weak market. Every single bull point has a serious risk sitting right across from it. That's the core of the dilemma. And if you want to understand that risk in one single number, here it is, 2.40. That is SNDK's beta. Now, in simple terms, that just means the stock is hyper volatile. On average, it moves 2.4 times as much as the overall market. So yeah, when the market has a good day, SNDK can have a great day. But when the market has a bad day, SNDK can have a truly terrible one. So, with an explosive bull case and a super high volatility bear case, how would a trader even think about approaching this? Let's break down the game plan from the source material, which is all built around one specific idea: buying a pullback to a key support level. The strategy is called a pullback to support long, and the logic is actually pretty simple. Instead of chasing the stock way up at its highs, you patiently wait for it to take a breather, like that 16% drop we saw, and you look to get in at a lower, smarter price. The whole goal is to get a favorable entry inside of what is still a very powerful uptrend. So what does that actually look like as a plan? Well, here are the 4 key steps. First, the entry zone. You're waiting for the price to come to you, somewhere between $566 and $590. Second, and this is non-negotiable, you place a hard stop loss at $540. That clearly defines exactly how much you're willing to risk. Then, third and fourth, you have your profit target set at $670 and then $725, where you start to cash in if the trade works out. And this right here is where the plan really comes together, because it's all about the numbers.
Based on the setup, the trade offers a potential reward that's 1.6 times bigger than the risk, just to hit that first target. If the stock makes a run for the second or third targets, that ratio gets even better, expanding to almost 3 to 1 or even 4 to 1. This is what traders are always looking for, an asymmetric bet, where your potential upside is way, way bigger than your defined downside. So let's get to the bottom line. The key theme running through this entire breakdown isn't just about the potential gain. It's about aggressively managing the risk that comes with a stock that moves like this. So what are the absolute most important takeaways here? First, the company's story is explosive, but the stock's chart is fragile after that huge run. Second, that extreme volatility means you have to be conservative with how much you risk. Third, the whole idea is dead wrong if the stock breaks that $540 stop loss level. And finally, and this is so important, this is a short-term trade idea. It's designed to capture a specific move, not a buy and hold forever investment. And this all leaves us with one final big picture question. In a market that's full of extremes like this one, how do you, as an investor or a trader, balance a company's incredible story with a stock chart that looks, well, a little bit dangerous? That's really the core challenge this whole case study brings up. And remember, one last time, this whole breakdown was for educational purposes. Trading involves a ton of risk, and it's definitely not suitable for everybody. You should always consult with a licensed financial advisor before making any decisions.